Hello and welcome to another episode of Mark's Mortgage Guide, where we take the top frequently asked questions that we find with our clients and that we find as we research all the questions online. What are the most popular questions when it comes to buying, selling, maybe even leasing a house or renting out a house, all of that kind of stuff. And so our goal with Mark's Mortgage Guide is to be an educator of a lot of these questions that you may have. So, we answer a ton of them. So I would invite you to, like, subscribe, share our podcast, anybody that you know of that may have one of these questions, and you can thumb through the titles and the table of contents, I guess, to see what questions we are answering. And if we haven't answered the question you're looking for, make a comment below, email us, give us a call, and say, hey, this is a really important question to me. And if it's important to you, it's going to be important to other people. So we'd be glad to shoot a video on that as well and do a podcast on that as well. What we're also doing is looking to add some real estate agents from the area that is going to come in, and we'll do a video podcast with them so they can answer the questions as well. So our topic today is let's see, it's what is a closing disclosure and how to read a closing disclosure. Number one, it's important to know what it is. And so I'll go over, 3 or 4 points. I like to keep this podcast to about 15, 20 minutes. It's a podcast that you can listen to or going to work or coming home from work. And hopefully we can get the question answered in a 15 to 20 minute time frame for you. But what is a closing disclosure when it comes to real estate, and how do you read it? Number one, what is it, a closing disclosure? And it's basically the synopsis of what is happening with that transaction. So it's going to have your sales price. I'm going to read off some notes here, but it's going to have your sales price, your loan amount, your interest rate, your proposed house payment, the estimated cash to close, and the closing cost broken out in closing cost and prepaid items, which are escrow accounts. So we'll go into a little bit more detail on that. But it basically has the initial one. It has to be to you within 3 days of closing. Now, the initial one is not going to be your final CD. In a lot of cases, there will still be changes to that closing disclosure, or CD is what you'll hear it referred to as. It used to be called a HUD 1, but years ago they changed it to a closing disclosure. And by law, we have to have an initial closing disclosure to you within 3 days of closing. So we can't just get to closing and then throw the numbers at you. So we have to get the initial numbers to you within 3 days of closing. Now, Sundays and holidays do not count in that. So if I get it to you on Monday, the soonest we close is on a Thursday. So we'll always, walk you through that, based on your closing date. When will we have to get that closing disclosure to you? But it's 3 days prior to closing. And in that closing disclosure, you're going to have, I think there's 8 different buckets, 7 or 8 different buckets that you will see on the closing disclosure. And obviously, I told you about the loan amount, the interest rate, the payment portion, stuff like that. But Section A is going to be the lender cost. So that's going to be things like maybe an administration fee, a discount point, or if the lender charges an origination point for their services. There's different ways for that to be covered, and we'll maybe have to do a different podcast on the lender charges and how they're covered in a different podcast. But Section A is going to be all the lender stuff. You may have an underwriting, you may have a admin fee or some sort like that. Section B is going to be third-party charges, which is going to be appraisals, credit reports, maybe tax service fees that your county will charge. Like appraisals, final certs. So if the appraiser has to do one appraisal and it's not final, they will have to go out and do a final cert of value. So that is going to be listed in Section B. And then Section C is going to be all of your title charges. We've talked about what title is and what the charges are, who pays for it, and different things like that. That's going to be in Section C. Section D is just A, B, and C added up together, so you're going to have that. And then Section E of the closing disclosure is going to be taxes and government fees. So that generally runs around 135 to 150, somewhere depending on that and the county. So the recording charges. So all the documents that you sign at closing have to be recorded at the courthouse to give you full rights to the property and all that kind of stuff. Now, you get full rights to the property the minute you close, but the title company is required to file all these documents at closing. So that's going to be in Section E. Section F is prepaid taxes and insurance and your escrow account, a part of your escrow account. So taxes, prepaid interest, because when you close, you will start paying interest on the money that you're borrowing the day you close. So let's say you close on the 30th of the month, and there's 31 days in a month. You're going to have 2 days of prepaid interest that they will collect at closing to cover the interest that the lender has earned for those 2 days. You may think, well, that's no big deal. Why aren't they doing that? Well, what if you closed on the 10th of the month? Now they'd have to collect 21 days of prepaid interest. So if they do it for one person, they have to do it for another person, no matter how many days are left in that month. So prepaid interest will be collected there. And then Section G is the initial escrow setup. And that is going to be things like if you have an escrow account, most people, if they put down less than 20%, they typically have an escrow account. Some lenders allow you to what they call waive escrows when you put down 10%, but the majority of people carry escrows accounts now. But if you want to waive escrows, you can certainly do that and take care of those on your own. But that's going to be in Section G of the closing disclosure. And so we're going to collect 3 months taxes, 3 months insurance, and then we're going to collect a total of another 12 months of insurance, because in the state of Texas, whenever you close, you have to pay 1 full year to the insurance company right off the bat. So, they'll take those 12 months and the title company will pay that to the insurance company. Now, you can choose to pay that directly before closing. And so in that case, we just need a receipt that shows that you have paid that amount to the insurance company, and then they would not collect that at closing. But we'd have to have proof that insurance policy had been that it is enforced at the time of closing, because it cannot be enforced the day after your closing. It has to be enforced the day of your closing. So in case there's a fire or something, your insurance would kick in the day that you close, because that was the effective date of the policy. So 3 months taxes, 3 months insurance for escrow, and then 1 additional year of insurance that goes to the insurance company. So you'll probably say, well, why are you collecting 3 months of escrow? Because if you close on let's say the 5th of May, and your first payment is now not going to be due until July 1st. So you have roughly 60 days in there that you don't even have a payment. So we're collecting additional months of closing. So when the bill comes due again in July of 2027, you won't have an escrow shortage. So in this case, if we're collecting 3, you're going to have 2 that's put back for the next year's policy, and then you'll have 1 year, 1 month that is in a cushion in case your insurance goes up next year. We're finding out right now that those cushions aren't enough, because insurance costs are going up so fast and so much that it's hard to keep up with what they may or may not be a year down the road, because it depends a lot on the losses, not only in your county but your state and across the country. As natural disasters hit the coast on the west coast and east coast, maybe a hurricane hits the east coast, a big fire hits the west coast. Well, the cost of those disasters are spread out throughout the country, and you and I pay for it, just like they will pay for any additional funds that insurance companies would have to pay if a hurricane hit the Gulf. So there's different things that you and I pay for that we have nothing to do with. So anyway, that's in Section G. And then Section H is other things like an HOA transfer fee, capital contributions in the situation where it may be a new build, and so the HOA is collecting some additional money there. So that kind of explains what a CD is. We talked a little bit about 3-day right of not right of rescission. That's in refinance, but a 3-day rule that where we have to get the initial CD to you 3 days prior to closing. And now we may have a few changes. Maybe you switch insurance companies late in the game, and so we have to go back and adjust the numbers that match whatever the new insurance policy is. The rate cannot change. The loan amounts will not change. Closing date may change because maybe something comes up with the house that hasn't been done, maybe a repair that needs to be done. So if that closing date changes, the prepaid interest date changes. So that always affects the numbers in different ways. So there's different reasons that that it could change a little bit. Maybe the seller jumps in and says, hey, you know what, we're going to pay $1,000 of closing cost in lieu of having something repaired. So that can always change. So what are some common mistakes that buyers miss in regards to a CD? Maybe incorrect spelling on the names. Maybe there's a middle initial that is left off. We'll go back in and correct that. Unexpected fees, we talked about that. Maybe a fee is good and maybe it's bad. Maybe there's like a credit. That would be a good fee that we could add to it. But then there may be other fees that pop up that need to be changed. But remember that they cannot. There's certain those buckets that we talk about. They cannot change more than 10% at all, or the lender has to what they call cure that difference. And now, if it's in Section A with the lenders, that can't change at all. They have to, pay 100% of that cure. But on the other buckets, there's like a 10% leeway in the cost, because when we send out an initial loan estimate, we don't know exactly what title company you're going to be using, what your insurance company is going to charge, what the taxes are for the property. So we send out an initial loan estimate, and those are going to be close, but those aren't going to be exact either. So anyway, loan type errors. Maybe somebody put conventional and it's conventional. And so we have to, double check all of those things for you. Seller credits may be missing, excuse me. If we prepare initial CD and then I look at it and say, wait, this guy is supposed to get $1,000 credit for this or that, or you've paid earnest money, that's something we all check for you to make sure that you're getting credit for everything that you've already paid, your earnest money, your option fee, any additional earnest money that you put down, and then any seller credits that they have offered to pay. We, as a lender, will go back in and double check all those numbers and then make those any corrections that that need to be made. Questions every borrower should ask before signing: did my interest rate change? Well, if we sent out a loan estimate when you got under contract and you decided not to lock in the rate at the time, then that could change depending on what the market is doing, because our rates change every day, and or they can change every day. And it's currently a very volatile market right now in the summer of 26. And so a rate that we offer today may not be available tomorrow. It may be available, but the cost of that rate may be different. It may be higher or lower depending on what the market has been doing. Did my cash to close increase? We'll compare those as we have our final phone call with you to say, okay, here's what we disclosed, here's what it actually turned out to be, and are all the credits included, and then what happens after closing. Typically with us, we're going to touch base with you a few days after the closing, because we know you have a lot being thrown at you at closing. You have a lot of documents that you're having to sign, and a lot of different things that you're thinking of doing. So we'll touch base with you a few days after closing to make sure you're good, and then we'll normally contact you about 30 days after closing to make sure that everything is good and you're set for your first payment and so on. So anyway, I think that pretty much does it. And one more thing is we will call yearly and to make sure that you're still in a good situation when it comes to your rate and your program. Maybe rates have changed significantly, and it's maybe a good time to refinance. We'll contact you and do an annual mortgage review to make sure you're in a good situation and make sure you're still in a very positive situation when it comes to rates. And we're of the opinion that, hey, buy now, and whatever the rates are, that's what they are. You can't control them. I can't control them. We can't control what they're going to do in the future. You can't either. And so, but one thing you can control is when you buy a house now, that locks in your price, right? They can't come back with you 6 months down the road and said, "Man, I wish I would have charged this. I'm gonna raise my price now." Nope, the price is locked in. So you're locking in that price when you close on that transaction and when you get under contract on that transaction. Rates may change down the road, so your rate can never go up unless you took an adjustable rate mortgage, but it can never go down unless you refinance. So as rates go down in the market, we keep an eye on your deal, on your particular situation, to make sure that you're still in a good, favorable position when it comes to rates. And if rates drop enough, we'll be reaching out to you to let you know, hey, now would be a good time to look at, refinancing your mortgage because rates have dropped and it's time to do that. So that's part of our service to you is shortly after closing, we will touch base with you about 30 days after closing, and then yearly we'll touch base with you and have a mortgage review for you. So anyway, all right, I think that's it for now. And if there's anything any other questions we can answer, certainly like, share, subscribe, make a comment, or email us and let us know, and we'll be glad to answer that question for you. So anyway, thank you for joining us today on Mark's Mortgage Guide, and we'll see you next time. Take care, everybody. Bye-bye.